Good afternoon, everybody. This is Birgit Kloos from The Right Place, and welcome to our second webinar in The Right Place's New Navigate webinar series. We launched this series last month in response to the really unprecedented challenges the West Michigan business community is facing. And as we grapple, all of us, with the new realities, not only posed by the pandemic, but all the other things that came along with it. We were created in 1985 by a group of business leaders. And at that time, we too were grappling with a serious economic crisis, particularly in our automotive industry, but other industries as well. So we were really created to guide our business community and help our business community through difficult times. And this series of webinars is meant to do that as well. We really want to bring you the latest expertise and resources so that you can make decisions in your company, particularly now as we all are grappling with what's next, where are we going. And one of the key industries in Michigan, of course, is the automotive industry. And the supply chain to that industry is critical to the health and well-being of the entire state of Michigan, but of course also to West Michigan. So today, we have a speaker whom I greatly admire and who I truly believe is the best automotive analyst in the business, and that is Michael Robinet. Michael is the senior leader and executive director for Automotive Advisory Services at IHS Markit. And Michael will take us on a deep dive into what is happening in the industry, what is happening to the structure of the supply chain, and what is driving post-COVID automotive supplier strategies, including adoption of electric and automated vehicles, the trade dynamics that are going on between the United States and other countries, partnerships, consolidation, localization, and the other critical shifts that are going on in the industry. Following Michael's presentation, we'll have a Q&A session with Glenn Stevens. And Glenn is the executive director of Mich Auto. And I also want to thank Glenn for his partnership with The Right Place for many years now, but we formalized that partnership earlier this year and have a formal relationship on exchanging best practices, and really bringing the expertise of Mich Auto to our auto suppliers here. So all participants in the webinar are set to mute. So you have two options in asking your questions. Preferred would be type your questions in the Q&A portion. So those are private, but there's also, of course, the chat box. You can do this anytime during the presentation. And with that, I will turn it over to Michael, and welcome, Michael. We are thrilled that you're joining us today.
Birgit, thank you for the introduction. And you and I have known each other for many, many years, and I really do admire your leadership with respect to The Right Place and all that you do for Grand Rapids, as well as your team as well. So thank you for the invitation to speak to your team today. All right, so that being said, as Birgit noted, it's an unprecedented time in our industry from a perspective of sort of the lack of the sort of the unknown, but the lack of the known in the future. I've been through this for over 3 decades, so we've been through Chrysler restructurings and exploding paint plants, as well as tsunamis and floods and the 08-09 financial crisis, but nothing like this. And in almost all of those cases, we kind of knew when the industry would find its way back up, or how it would find its way back up. This one has a lot more, many more unknowns to it. So we'll take you through that. And as Birgit also noted, we're really, the title of today's presentation, Navigating a New Reality. It really is a new reality. And you hear a lot of interesting, phrases and such as, it's a new norm and all those types of things. But if you do think about how the industry has had to react to everything that's happened, and how they're going to have to react and really restructure their operations to be profitable and sustainable in the future, it'll be quite interesting. So as mentioned, I'm an executive director in an advisory practice over at IHS Markit in Southfield, and we're frequently with suppliers, especially small to mid-sized suppliers, helping them with strategic options, better understanding where the market is moving, looking at new sectors, vertical integration. And trust me, we're very busy right now, given the liquidity issues and some of the other factors that are impacting the industry. So suffice to say, if you do need some assistance, please drop us a line. Many those of you on the line who are in the automotive industry or tangential to automotive, maybe in the financial side, you're already clients of ours. And so again, thank you for your business. So that being said, what are we looking at? So we've got this COVID automotive supplier journey. And again, I'll go quickly, but we had this pre-COVID period where at the beginning of the year in the first quarter, we still had suppliers licking their wounds from the GM strike of the fourth quarter and trying to make some semblance out of their 2019 year, hoping that 2020 was going to be a stronger year, at least from a stability perspective. And then, of course, we started to hear about COVID in China, and then the industry starting to shut down, especially in Wuhan. And then that expanded to other parts of China. Then it, of course, found its way over to Europe, and then eventually, as you well know, to North America. So it was a very active period from, let's say, the beginning of February to the end of March, where literally all the major regions in the world from a production perspective, China, North America, and Europe, all more or less shut down within a 6-week period. So unprecedented from that perspective. And I think the smarter suppliers started to building sort of their fortress balance sheets, going to their banks, pulling in what liquidity that they could, reducing variable costs, slashing their capital budgets, really looking at operations and saying, okay, how can we basically go into a paralysis mode for a period of time, because we really don't know what the end is going to look like. So we had that production shutdown that started in March, late March, especially in North America. And as we well know, other factors got impacted, such as slower vehicle development and or ceased vehicle development. So that pushed off a couple of vehicle programs in terms of their launches, either into later this year or early into next year. Again, always a domino effect as we worked our way through. We had interesting things such as the EPA shutting down. How do you actually get a vehicle registered unless you've got that ability within your own organization? So again, these are all really interesting factoids that kind of work the way through as the industry shut down. And then we had this production restart, which we're really in the middle of right now, as you well know. And it's actually going relatively well. I will say that there was a lot of discussion about the supply chain not surviving and the like. And I would say that the OEM supplier distress teams, as well as even the tier 1 supplier distress teams with their upstream suppliers, have done a great job making sure that the supply base was whole, working through any issues, either liquidity issues or logistics or personnel type issues. And again, we're not out of the woods, but it's actually been relatively few issues with the supply chain. So again, a resilient supply chain. But in this restart, think about, put your sort of CFO hat on for a minute. You start building parts in late May, and you're not going to really receive any receipts for those parts probably until the middle of July, if you're on a 45 to 60 day window. So we've got this period through June and through good part of July where there's no revenue coming in, but a lot of money going out the door. Labor, obviously efficiency issues, PPE, all those types of factors are working through the industry. So we do feel that there's the pressure on the supply base is really going to become intense in that July, August, and even the September type of time frame, as the volumes are not quite as strong as when they entered. But we've also got a tremendous amount of activity from a financial perspective in terms of money going out the door. And also remember that some banks gave some suppliers a 90-day window to suspend principal payments and other types of progress payments, but 90 days will be up. And so those payments will have to start over again. So there's going to be still significant pressure. And as we'll show you in a couple of minutes, we don't think that this is sort of a one and done. We do feel that this is going to have an impact into 2021, especially not only on volumes, but how you approach your business. So let's take a quick look at, this is really sort of a continuum of the supply base. If you think about the supply base from a tier perspective, you got the mega tier ones. So, you know, the Magnas, the Ishins, the Contis, the Bosches of the world. There's probably about 10 of them on the list that you can think of that are in several different sectors, are global, are very, very capable, and have fortress balance sheets. Many of them anyways are very, very strong. Then you sort of move ahead to the mid-sized tier one, and those are sometimes anywhere between, let's say, you know, $300 to $400 million in revenue, up to, let's say, 2.5 or 3 billion in revenue. That's sort of what a lot of people think that mid-sized suppliers are in terms of size. They're the ones that are probably a little bit more at risk through this whole process, because they are a little bit more focused usually on one or two segments, as opposed to, let's say, the mega tier ones, which are probably a multi-segment, 3 to 4 different capabilities, whether it be maybe steering or HVAC or body in white or safety or other types of electronics. Again, mid-sized players usually only focus on one or two areas, and sometimes they're very regional and not as global as they probably need to be. So again, that's where we feel that there's going to be a significant amount of pressure. But even the small and startup players, where they're probably a little bit more nimble, but if the banks are not going to support them possibly as much as they would have expected, then that certainly could be a problem as well. So that's sort of an idea of the supplier continuum. And we do think that through a lot of this debt and liquidity issues going forward, that there's going to be some consolidation, and we'll certainly talk a little bit about that later. So as a supplier, you know, we've counseled a lot of suppliers to kind of sit back and say, you know, what do we do other than sort of the short-term blocking and tackling of reducing your variable costs, looking at your capital budget, you know, trying to work with your bank, those types of things. It's really also really understanding what resources are required from your organization in terms of development of components and systems to support upcoming launches. And we're also encouraging a lot of our clients to, do you really understand your competitive set? Do you understand who your competitors are, what situation they're in, what upcoming major programs they've got, and what challenges they're going to have? So a lot of smart suppliers did reach out to their OEM customers and say, if there's some takeover business, you know, we're willing to have a discussion about it. And I think that was very wise by many suppliers. So again, this is a very busy time, but also a really important time to really take stock from a perspective of what your future strategy is. And one other factor I think is important is through this COVID experience, and unfortunately, you know, many people have passed away due to this, and it's truly tragic. But also it causes one to kind of stand back and say, how do I continue to reduce risk in my organization? And what we're finding is a lot of suppliers are standing back and saying, well, how do I reduce my capital risk? How do I reduce my enterprise risk? How do I find the ability to service more customers? Do I find some new segments to service? How do I sort of reduce risk in this environment? Because as certainly as we go forward, it's going to be a little bit more treacherous, and the market is going to be a little bit more erratic going forward. Now let's go into the outlook. I don't want to burden you with too many numbers, but those that have seen me present before know that there are some numbers coming. And I think the biggest number, to be honest with you, is GDP. GDP is still a major driver of economic activity, as we all know. It's a major driver of vehicle sales in terms of the pace of vehicle sales and the inflection. High economic activity, high vehicle sales. Obviously, a lot of turnover. People are employed, low unemployment. You get the relative idea. Our forecast for global GDP is going to be off at 5.5%, and that is our latest number that came out of our economics team. And again, they're continuously revising it, but trust me when I say it's going to be negative. And certainly from our perspective, almost unprecedented. I can't remember ever a time where the globe has fallen back by 5 points in terms of GDP in any one particular year. So we do expect 2021 to be positive, but remember, a lot of it's mathematics. We've fallen back 5%. So certainly one would hope that if we're going to at least grow slightly, we're going to be a little bit above that from a growth perspective. Nonetheless, industrial production is overcorrected. Of course, that makes sense as you have lower economic activity. You need to pull inventory out of the system. You're servicing a lower level of sales, whether it be in the vehicle market or even in other markets. And as the market starts to come back, then you'll overcorrect slightly as you start to build up inventory. So it's that inventory yin and yang that really determines what's happening in the market. Let's focus. Obviously, we talked about our global GDP off about 5.5%, but the U.S. is outpacing that, unfortunately, at off more than 7% for 2020, up 5% next year. But again, a lot of that is taking a look at what the mathematics tell us in terms of obviously that is not going to be a high growth market at only up 5%, being off the year before at 7%. Certainly, you can see virtually every market is going to be down year over year. Even China this year, we think that they'll eke out a small percentage growth. That's really saying something for a market that has been averaging 5 or 6 of late, and even as much as 8 and 9%, earlier last decade. So it's a sad reality on how the world's coming back. And I will tell you that these forecasts really assume that there's no major second wave. And again, that's where the transparency and the erratic nature of the forecast really comes about in the future. Oil is still proving to become very difficult to forecast. It's got political factors, economic factors, and also consumer confidence works its way into it. But suffice to say, I think the message that we usually tell clients is that oil is going to stay at a fairly reasonable rate, let's say below $60 or $70 for an extended period of time. And that being said, that is not, the price of oil is not going to be a major driver in, pushing people into small vehicles or enticing them to purchase more larger vehicles, at least in North America. In Europe and in China and other locations, oil is more heavily taxed, and therefore the real price of oil doesn't necessarily come through quite as quickly as it does in North America. But suffice to say, an environment of low oil is going to be helpful. Global production scenarios. Well, our optimistic scenario let's back up a bit. Our pessimistic scenario is twice as negative as our optimistic scenario. And that makes sense. If you think about how the market is moving, the fact that we don't know about a second wave, there are obviously many forecasts of what will happen with unemployment and other factors in the future. But nonetheless, it's critical to really understand that from a negative perspective, the globe could lose well over 40 million units over an extended period of time if we really look at the longer term perspective. There are some upsides. There could be about a 20 million unit upside over a 5 or 6 year period going into 2027. But suffice to say that our pessimistic case has a higher likelihood than our optimistic, and our base case is at about 50%. But nonetheless, when do we get back to our prior high of 2017 at around 94 or almost close to 95 million units? That number, we may not get back to that number till 2025. So it's going to be about an 8 or 9 year hiatus between that high point of 2017 till we get back to 2025. And we'll talk a little bit about how we could potentially get back to that level. So you got this pre-COVID, COVID, and post-COVID environment. And again, really understanding how that's going to work its way through. Some of you have seen our presentations before, know that the industry is becoming a lot more, not only consolidated, but much more collaborative. And for good reason. You've got many challenges in front of them, whether it be electrification, or automated driving or automated ADAS content and the like. You've got other issues such as market dynamics, scale economies, high competition. And so what you're finding is that virtually no OEM can really survive this market on their own. Even large players like Toyota and Volkswagen are finding other partnerships to reduce their risk and to increase their scale, and also increase speed to market with respect to various technologies. So you can see examples here all the way along the top, let's say 10 to 13 or 10 to 12, excuse me, OEMs. When you really look at a much higher level of collaboration and partnership, the whole idea between FCA and PSA was really driven by scale, driven by electrification, and driven by risk reduction. Capacity utilization has also turned out to be quite important. I will tell you that up till, let's say 2 years ago, we didn't bother talking about capacity utilization. It fell on deaf ears. People said, well, plants are running on 3 crews and 3 shifts. Why do we even care about capacity utilization? Well, as capacity utilization has reduced by almost 30 points in Europe, and in even more than that, almost 40 points in North America from 2016 to today, it quickly becomes a very important issue. So there are a lot of dynamics behind capacity utilization. It's not only the production levels, but what capacity is being brought online, what capacity is being taken offline. These are all significant issues going forward. And I would say that we do think the European market will come back, but remember that there's a couple of players that are going to be evacuating out of Europe, namely Honda. Toyota will be reducing their footprint. You've got consolidation between FCA and PSA, and also a little bit more turmoil with respect to the European production side with respect to exports. So again, there's a lot of dynamics at play here. China is the interesting one. There's a number of Western OEMs that brought on new capacity in 17 and 18, just as the market was retrenching. Then we had a number of new electric vehicle companies like Xiaopeng and others that have come into the market, added capacity into the market. But also note that we've added a lot of the capacity. What happens in 22 or 24 when the market starts to rise, but we're having to absorb all this capacity. So that will drive potentially some consolidation in the China market, something that has been well predicted for a while. And then in North America, the market that obviously is near and dear to most of us, we do see an improvement, but remember that we've added some capacity either with BMW or Toyota or Volvo over the last couple of years. Other German OEMs have added capacity. And then we've also taken a little bit of capacity offline. GM has right-sized a bit of their capacity going forward. So there are some adjustments here. And remember, back in 2016, we still had a number of facilities working on 3 crew, 3 shift structures. And as you take those shifts off, obviously your capacity utilization declines at the same time. So just let's have a quick look at the European market. And essentially, these are our most recent volumes per our June forecast. What you're finding is before we talk about the overall volumes, notice what's happening with production share. Finally, Europe is consolidating. You've got Volkswagen, which of course is Volkswagen, Audi, and Porsche. You've now got an FCA and PSA that, well, maybe by the end of the year or early next year will be one entity in some way, shape, or form. You've got RNM, Renault, Nissan, Mitsubishi, which are now the number 3 player in that market, and then a couple of other luxury German makes, Daimler and BMW, and then after that JLR. But remember that Honda is evacuating out of the market, Toyota is reducing their footprint, Ford's reducing their footprint. So there is some consolidation occurring in the European market. Probably more important is the fact that we hit a high point in 2017, about 22 million units. And this is Western, Central, and Eastern Europe, including Russia and Turkey. But we don't expect to get back up even close to that level until possibly 2027 or 2028. Some of that will be driven by additional volume in Central and Eastern Europe, and certainly not so much Western Europe. Europe is a market that's undergoing a significant amount of change with respect to propulsion, greater levels of electrification, lower levels of exports as trade disputes continue within the world. It'll be more difficult for Germany and for the UK and to a lesser extent Italy and a couple of other markets that have been major exporters to continue to go down that road. So those are some of the ongoing issues in the European market. China market is a slightly different story. We've been hearing about a lot of positive news about how well China has come out of this. And interestingly, if you think about it, China has performed the best, sort of first in, first out. Then North America is performing relatively well in terms of coming out of COVID. And then lastly would be the European market. But you can see here, we're expecting by 2024, 2025 to get back up into that over 26, 27 million unit range, really driven by tier 3 and tier 4 cities, also some economic expansion in China. But remember, exports are really under siege these days. So that means exports out of Europe to China, exports out of Europe to North America, exports out of China to North America, possibly to Europe, and certainly exports out of North America to any of those regions. So it is restructuring the production structure, or the production portfolio as we go forward within each of these regions, given some of the issues that we're seeing on the export side. But nonetheless, we do feel that China will continue to lead our industry from a volume perspective out of this pandemic, and as I mentioned earlier, probably closer to that higher point by 25 or 26, 2025, 2026 from a volume perspective. We do expect the domestic Chinese players to continue to have some issues, but that doesn't mean that the Western OEMs aren't having issues as well. We've seen companies like JLR, FCA, PSA, Renault, all really have some significant headwinds in the China market. So let's focus a couple of minutes on what's going on in the United States. And this is this was a great result at the end of May, early June, that came out with inventory. Inventory ended up around 2.6 million units. It's a wonderful result. You're probably thinking, why is he so giddy about inventory? Well, a couple things. We were able to sell some vehicles in May, which was great news. We didn't produce a lot of vehicles in May, so that helped get inventory better under control. So then when we exited this is the point of exit, you've got the vehicle manufacturers flexing their muscles as much as they can at their facilities to produce fairly strong, probably through the July-August timeframe. Likely the bigger issue going forward is going to be what happens in that fourth quarter of this year when we're in full election mode. We've got the industry is sort of full back up with inventory back up to let's say a 3.5 million unit level, which is a little bit more normal given past times. So a lot of issues are really at the forefront of consideration over the next couple of months. We get a lot of questions about fleet, and so this is again a little bit of a busy slide, but I just wanted to give you an update on how fleet is made up. And fleet, as you well know, is sort of, let's call it non-retail, but you've got the rental fleets, so your Hertz's, your Enterprises, Dollar, Avis, etc. Commercial fleets, so companies like a Hewlett Packard or an IBM or other major companies will buy a fleet of vehicles to service their own needs, or even within even from a delivery perspective, you've got commercial fleets as well. And then the government, so that would be municipal fleets or military fleets or the federal government. And as we well know, there's been significant issues with fleet to a perspective that we're really not expecting fleet to even come back until the end of this year or maybe early next year. And that really depends on how quickly the consumer comes back to travel. Travel is going to be an ongoing issue going forward. So again, fleet, if you evacuate fleet out of the market, you're looking at well over 2 million units of volume that quote unquote disappears. And this belies some of our thoughts of what could happen a little bit later on in the year when that full impact of not having fleet around could be felt. So what are some of our North American scenarios? Well, this is, again, our pre-COVID, post-COVID perspective. And interestingly, if you look at the line between, let's say, the green and the red, that's our base forecast. As was highlighted earlier, our pessimistic forecast is twice as pessimistic as our optimistic forecast, if you follow the line of logic. And interestingly, you see that our base forecast outstrips our opportunistic or our optimistic forecast by 2022. And that really is driven by the pace of the revival of the market, and our thought that in an optimistic scenario, we could be sort of pulling some volume ahead, and that volume would probably come from that late 2021, early 2022 type of time frame. But nonetheless, there are many aspects to this we don't know, and that's where it gives us still some pause from a pessimistic perspective. Let's take a look at what some of you in our market really look at very closely is what have the production rates been on a monthly basis. And you can see here that in April, we basically went down to, actually, it's a little bit more than 9,000 units. That was the final number that our team came up with in terms of total production in April. May is still a little bit up in the air. It's probably around 218,000 units, and that could fluctuate ever so slightly. The bigger issue is how quickly can we come back in June and July. So what are you looking at here? Our green forecast, the green line, is our forecast from February, which was sort of pre-COVID. Our forecast from the March timeframe, where we started to feel the impact, is our gray line. And then the black line is really our current forecast that literally just came out a couple days ago. And so you can get a feel for our current forecast is in that 12.5, 12.6 million unit range. And a lot of that depends, to be honest with you, is not so much on the production, the climb of production over the next couple of months. It really is more predicated on, frankly, what happens in the fourth quarter. And you can see that we're expecting the fourth quarter to be strong, but more, let's call it more strong-ish, in a sense that probably not as strong as what we have expected before. And that kind of gives way to what 2021 could look like. And this is, and I apologize, it says 2020 at the top here, but it really is 2021. This is our forecast for 2021, back before COVID and now with our latest forecast. And you can see that on a monthly basis, we're looking for somewhere between 150 and possibly sometimes up to 200,000 fewer units each month as we kind of work our way through. And then it gets a little bit better towards the end of the year. But nonetheless, given the fleet dynamics, given the fact that we won't be exiting this year at 4% unemployment, economic activity will be certainly lower. And then obviously a lot of the economic issues that are driven by the election and the amount of investment that we've had to make in the economy to keep people either working or at least keep people afloat with respect to the CARES Act and other types of initiatives and incentives. So nonetheless, 2021 was looking to be a decent year, but some warning signs and some darker clouds have certainly come around. So that really gives us a little bit more pause from a perspective of what does 2021 look like? And you're probably thinking, well, shouldn't you just be talking about 2020? But in some respects, the cake for 2020 has been baked. We have a perspective of how we're going to climb out of this and a decent view of what may happen in the fourth quarter with inventory and the like. But probably more important, to be honest, for the supply base is really understanding what's going to happen in 2021. And what we've been telling our clients is that, you know, where you might have been expecting a high 15 or low 16 year in terms of North American production before this point, as we kind of look forward, that's going to be a little bit more difficult to reach. And so the volumes are not getting back into those more lofty 16 million unit ranges probably until 22 or 23 as we start to approach that level. So essentially what we're saying is it's not going to be as bad next year as it was this year, but it certainly will not be as good as what you thought it was going to be before COVID. And so therefore, we're expecting suppliers to continue to make adjustments in terms of how they address the market, how they move forward with respect to their strategy. And a couple of other factors I think are critical here is that crossover utilities will continue to take a strong share of the market, close to 50% by 2023. You see that pickup trucks, with low fuel prices are going to continue to do well, but remember they're also very commercially oriented. So lower commercial activity will certainly impact some pickup truck demand. And then lastly is exports. And there was a time where we thought that exports could reach as high as 16 or 17% of total production. And this is exports outside of North America to Europe, to China, and other locations. But given some of the trade dynamics, some of the reshoring and localization going on, that's probably not going to be the case going forward. A couple of other final notes are, first of all, cadence. And cadence is that whole idea of when vehicles are launched. And we had assumed before COVID that there were probably going to be close to 29 launches in 2020. But obviously with COVID, some of those have been pushed out. So a couple pushed out to 2021 and into 2022. So that's kind of back-ended some launches. But also one would expect that some vehicle programs could be a little bit more delayed because the OEMs just don't have the capital that they used to. Neither do the tier ones or tier twos, to be quite honest. So I think you're going to see sort of a rethought and a reevaluation of R&D budgets and advanced vehicle budgets in terms of the timing and can they continue to produce some of the older vehicles a little bit longer and spread out some of that future capital going forward. So these are all going to be critical issues. And two more slides I wanted to show, and this one's a fairly thick slide, but I think the real story here is that electrification in North America, I had clients call me up and say, well, I guess it's electrification dead. It's like at your detriment if you think that. It really isn't, especially given some of the electoral dynamics that could happen by the end of the year. If we have a change in power from a party perspective, then this, higher emission standards could be alive and well at some point. But even without it, our expectation is that, yes, there probably will be a little bit lighter penetration on BEV, possibly a little higher on hybrid. And so OEMs will probably take the lower cost alternative to meet their emission standards. And that will probably mean a little bit more hybrid. But nonetheless, we're still looking for probably around 7% of the market to be battery electric vehicle by 2025. Europe and China are a little different. This COVID impact has actually restructured some budgets so that instead of using more hybrid for the next couple of years, they are actually just in some cases shifting dollars or euros or RMB over to the BEV side because they're going to need it by 2025, 2026. So we're actually expecting a slightly higher penetration of BEV both in Europe and in China. And then lastly, our autonomous sales forecast, our technology outlook has really not changed that much. This is content that is not so much legislated, but really demanded by the consumer. And we had already made some adjustments to this forecast late last year. So the real inflection here has not changed that much. So just to summarize that together, and I know we've got some time for questions, and I really look forward to that. The COVID rebound will be multi-speed. And we've seen that China's sort of on the 10th speed, and we've got US sort of on the 7th speed, and then Europe at sort of a 3rd or 4th speed. So if you want to think about it in terms of a 10-speed bike, and unfortunately, that's really the way they're going to come out of this. Longer term, obviously, there's some different factors to take into consideration. Electrified propulsion is still around. So if you were thinking that you were going to walk away from a presentation like this and say, hey guys, we're all set on internal combustion engine powertrains for the next 2 decades, and we can just ignore battery electric, I have news for you. That's not the message that we're delivering. It may be a bit delayed, maybe a bit different, but it's still coming. And then the launch opportunities, I encourage all suppliers and even those in the financial sector who are servicing the suppliers, please have a strong understanding of when you're launching your vehicles and when the capital is going to be required. It's a moving dynamic right now, and the OEMs are trying to settle in on where that could be. So with that, I think that there's also going to be, hopefully we outlined this earlier, still some consolidation on the OEM side and certainly on the supplier side as liquidity and other types of issues continue to take hold in our industry. So, with that, I want to thank you so much for your time, and I look forward to questions. And again, we'll hand it over to Glenn and Birgit.
Hey, Mike, thank you. I mean, I've seen a lot of your presentations over the years, and appreciate your insight. And this really wraps things up, as well as can be wrapped up right now. As you said, we're in times we didn't anticipate, and a lot of the information is hard to digest sometimes because you just don't know. And there's some downside out there, but it's where we're at. Let's bring it to West Michigan. We got about 10 minutes here. West Michigan really well. The supply community, the technology community, the people there. If you had to give some advice, really boil it down from what you presented and what you're seeing to the companies there in that area of Michigan, what would be some of the real critical things that you would drive to them?
Well, you're right, Glenn. I do know the West Michigan supply base very well, and I've been active with them for well over 2 decades. To be honest, I find the West Michigan supply base very innovative. They're also, very, they like stability and they like to reduce risk where possible. And I think most suppliers are that way. They're not willing to take too many flyers on the market. My advice to them is to sit back, take a look at your strategy in the wake of what's going on with respect to COVID and your competitive set. I mean, I think that is really critical. Most West Michigan suppliers I know are well capitalized. A lot of family-run companies, they do extremely well, and they're well capitalized. This is an excellent opportunity to look for opportunities. Excellent opportunity to look around at your competitive set and say, Joe's not doing so well. Alex is having some issues. And either going to your customer and saying, is there some business you want me to take over? Or attacking it directly and saying, listen, if you're having some liquidity issues, let's have a discussion. And again, that seems very abrupt. But like I was saying earlier, West Michigan suppliers, from my experience, are very well capitalized. And this should be looked at as an opportunity to either solidify your presence, expand your scope, or look for even other ways to reduce risk.
Picking up on that, something that I've seen over the years by visiting companies there and walking the R&D centers and the plant floors, there's a lot of innovative things that are done with regards to strategic partnerships in the region, in North America, and even globally. Do you see that as something that people really should be taking a look at, even more so now in this environment moving forward?
Yeah, and to be honest, Glenn, even before this, what we're finding is that companies were less willing to put capital up from a risk perspective. The speed of the market also was dictating that to organically build a new capability sometimes might take 4, 5, 6 years. Go hire the people, bring in the technology, find customers, build a base, enter new sourcing relationships. What we're finding now is that inorganic growth by acquisition or consolidation or partnership is really the preferred mode these days, and almost has to be to find the right people, to find the right relationships. You don't have the luxury of time any longer. So that inorganic approach is really, really critical to help move these companies forward.
Switching gears a little bit here, I got a question from the audience. How much do you see the trend towards ride sharing or the trend away from ride sharing potentially play into the forecast at this point? Do you anticipate that it's going to have a stronger effect on the auto market in the future or less? And, how is the West Michigan base play into that?
I would say that, near term, it's obviously going to have an impact on travel. It's going to have an impact on, the Ubers and the Lyfts of the world, at least near term, until we can get sort of past this. I'm a little bit more optimistic that we could run closer back to that normal. I think we've seen a lot of companies take strides in terms of reducing bacterial infection or and the like within the passenger compartments and the like. So we've seen, different technologies that really utilize a lot of the know-how within automotive, but applying it differently going forward. I will say that our ride share forecasts have probably been impacted slightly, but probably not as much as you would think. A lot of the basis for the reason and drivers for that growth of that forecast, at least mid and longer term, are still in place. And so therefore, we're really not expecting major changes. Maybe short term, our launch point might be a bit different. With respect to West Michigan companies, they've always been very innovative, getting back to my earlier comments. And I think that they're pragmatic, and many of them are looking at some of these challenges that are impacting rideshare and trying to find a way to profit from it.
Okay. Put some reality to this whole conversation around reshoring. Obviously, there's been a lot of talk about that. Started with the PPE manufacturing, but it certainly has transferred into component manufacturing. It's such a globally intricate supply chain, and so many vehicles produced in so many places on the earth. Is there opportunity there?
I think absolutely there's opportunity. There's certainly some opportunity in components that are lower labor value add, where labor is a much smaller component of the total cost of the system, where maybe it was coming in before from China or Europe, and the OEMs and or tier ones are dictating, I want that supply closer because I'm trying to take risk out of my supply chain. I'm trying to take currency out of my supply chain. And again, for those that aren't aware of that, but if you're purchasing a component and it's an RMB and you're always dealing with an exchange rate to the US dollar and it may go up or down slightly, you really don't know what your future costs are. So we're finding that OEMs and tier ones that they want those components and systems be brought closer to our shore. And that really means more of a NAFTA or USMCA type of structure from a perspective of at least get it within our trade block. And we're finding that I've got a number of clients that are being asked that, okay, we tolerated it for a couple of years, but we need you to take those components that you were sourcing out of China and bring them to North America, find a way to get them here. Get them to Mexico, get them to the southern United States. We got to find a way to get them here because we're not willing to pay a tariff any longer. We're not willing to put the risk of a supply chain disruption. And we also don't want to deal with a lot of the currency issues that we've been having to grapple with of late.
Right. To pick up on that, we've got USMCA staring us in the face right now. When I was over earlier this year for the West Michigan Supplier Forum at the Van Andel Trade Center, a great presentation from a gentleman from Shape Corporation about implementation for USMCA. The further you go down in the supply chain, the resources are limited, but your thoughts on whether or not suppliers are ready, or it's a very difficult time to be adopting and absorbing something like that right now too.
Yeah, I agree. I mean, I think organizations like, Mish Auto and Right Place and OESA and others have done a good job of sort of warning the supply base that, oh, by the way, as you're dealing with COVID, don't forget that USMCA starts on July 1st. And that's unfortunate. I think that the starting point is very unfortunate and probably, from my perspective, maybe a bit ill-advised from the administration's perspective, but nonetheless, it is what it is. There is a little bit of leeway for the first year. As you were saying, that the administration is willing to take estimates and knows that there's going to be a lot of sort of slack in the system for the first year because it's implemented so quickly in the middle of a pandemic. As the industry starts to come back up. But I will completely agree with you. I think that the reporting requirements are much stiffer. and it's almost as if they've got to learn a new language with respect to compliance and dealing with their customers from in terms of labor value add, metallic buy, total value add. These are all factors that, frankly, the industry didn't think too much about before because it complied. Now it's a little bit more dodgy whether you'll comply in the future.
Okay. Couple quick questions to end on. We talked about reshoring, from a bigger picture standpoint. Given that those West Michigan companies again, do you think there's some more localization opportunities, even regionally, in the Great Lakes region with the plants that are around us?
I think absolutely. There's always going to be opportunities. Most of the West Michigan companies I know are very well run and are extremely efficient. So there's really no reason why they can't accept more business. And I think that part of that supplier consolidation could play into the hands of strong, well-run West Michigan companies that are well capitalized, have a long-term perspective, and maybe looking at some of their competitors, maybe over on this side of the state or possibly down south or in neighboring states, and say to themselves, you know what, I've got a better position and the OEMs know it. I might find a way to consolidate some capacity here and consolidate it back up to West Michigan. So there's always an opportunity here. I think that the DNA of West Michigan suppliers really plays well into at least taking an advantage of, unfortunately, this whole event that we've been working through for the last number of months. Right.
Well, last question, Mike. There are some great new products coming out too. Pretty significant products, particularly for some of the Detroit 3. Anything catch your eye, or anything that you've seen, or anything that really intrigued you? And maybe it's a product, or maybe it's a technology, but what do you see that's innovative from a product or a capability standpoint? That's something you've got your eye on.
Well, I mean, obviously there's lots of product out there, and you've got the new T1XX SUVs that are coming out. You've got the new F series, but also some vehicles on the car and the sedan side. But being a little bit more of a gearhead from a supplier perspective, I love to see some of the new technologies that's coming out from the supply base. And I think what you're finding is that less is more is turning out to be a real rally cry within the industry. And what am I referring to? If you think about the number of control units, electronic control units that are found on a vehicle, sometimes it is over 100, sometimes 150 different little control units. The OEMs and led by suppliers are starting to really attack that and bring that down into the 20s and the 30s and the 40s. But it's a lot of work. It's easy to just say, redo it the way we did it last time. It's a little bit more difficult to say, let's combine this, and this all together so we can drive some economies of scale. So I think that combined with the challenges of electrification, the challenges of autonomous, but also the challenges of what the customer is looking for and really meeting the needs of the customer, it's going to be a really, really critical 5 to 10 years in our industry. And I'm so happy I'm on the sidelines to be able to watch it.
Mike, thanks for your time today, and thanks for the insight for all of us. It's greatly appreciated. You're a friend of the industry, you're a friend of ours, and a friend of mine for a long time, so I really appreciate it. Thank you.
Thanks,
I'm going to turn it over to Birgit to wrap up. Birgit, thanks to the Right Place team for the opportunity today, and thanks for the partnership with Mish Auto and all you do. So over to you. Thank you.
Thank you. Thank you, Michael. Thank you, Glenn. This is great. Most people who know me know I love automobiles and the industry. And it's, to me, the most complex consumer product is an automobile, if you think about all the parts that go into it. And I appreciate, Mike, your overview, and I hope everybody else did too. This is still a critical industry to Michigan. It's a critical industry to West Michigan. And I do believe that there are always opportunities during difficult times. So I hope everybody enjoyed the presentation. It will be posted on our website, and it will be sent to everybody who registered and participated today. And please feel free to share the webinar with your team and anybody else you think could benefit from the knowledge. We will be hosting another webinar next month, and we'll be getting the information to you shortly. In the meantime, again, thank you everyone for participating today and listening in. And Michael and Glenn, thank you as always for the outstanding presentation as well as really a terrific Q&A. That concludes our time together today, and thanks again to everyone.